Evolution AB is dominating a $100 billion industry, yet the stock is flat for almost 4 years now. Is it an opportunity with the stock being 40% down from all-time highs, or is it a sign of trouble? Let's find out. Evolution AB is a Swedish company known for its live casino games and innovative game shows. They offer live dealer games like blackjack, roulette, and poker, along with interactive game shows like Crazy Time, Lightning Roulette, and many others. This is called iGaming. Evolution's history dates back to 2006, inspired by the iconic Monte Carlo casino. Founders Jens von Baar, Fredrik Osterberg, and Richard Hadida wanted to bring the excitement of live casino play directly into players' homes using emerging technology. Evolution AB's brand promise is delivering a product that's as real as it gets, with the core value alive. In their first studio in Latvia, they broadcasted the BBC newscast to prove real-time gaming. From 2006 till 2017, all growth was organic, growing to $211 million. In the last few years, under a new CEO, Evolution did multiple acquisitions, expanding their portfolio in both slots and live casino. This made them grow revenue from $211 million in 2017 to $1.9 billion in 2023. This is their current brand portfolio. This brand portfolio will be expanded with Arcadia Gaming Solutions and Galaxy Gaming at the end of this year and next year. Galaxy Gaming from Nevada develops and distributes innovative games to physical and online casinos worldwide. Arcadia's technology enables players to engage real-time with a physical arcade machine. Let's dive deeper on how the company really earns its revenue. Evolution operates a B2B model, partnering with online casino operators to provide them with live-streamed gaming solutions. The company generates revenue through multiple streams. The majority of Evolution's revenues consist of commission fees, calculated as a percent of the casino's winnings generated with Evo's offerings. There is also dedicated table fees. These are monthly charges to operators, exclusive per operator, in a specific language, for example. In addition to commission and dedicated table fees, there are other smaller sources of income such as setup fees, which are invoiced to new customers. This graph shows the business model visually. Evolution divides revenue in two divisions, Live and RNG. Live are their games like Mega Ball, Crazy Time, Funky Time, etc. If you have never gambled online, this obviously says nothing to you. This segment is 85% of revenue. RNG, just like in video games, is random number generator. This is something that makes the outcome 100% randomized. The best example of this are just the regular slots. Live is growing as a percent of revenue because this is a way faster growing market, except for the third quarter of 2024, by the way. Here you can see Evo's revenue per region. As you can see, the regulated market share is 40%. This means 60% of revenue is from not regulated markets. Many countries don't have regulation for online gambling yet. They tend to have rules for land casinos, but not for online. In these countries, it is not illegal to gamble online, but also not regulated by a government. Some countries have a monopoly, where one operator is permitted. Regulation is an important growth factor because it brings more potential users. Some recently regulated markets, where Evo is investing in for future growth, Philippines, Brazil, and Czech Republic. Their Philippines studio will be their first in Asia. They believe eventually more countries will regulate in Asia. I quote, "Just like in Europe, once upon a time where UK regulated and other countries would follow, I think that we can see the same trend. Could take 10 years, it could take 20 years, could take 5 years. We do not know that, but it will probably." Evolution uses AI for a more personalized experience. They also use it in their game development to analyze player behavior, for example. The total online casino market grew 15% in 2023. Evolution has a medium to long-term target to increase the gap with competitors and grow harder than the market. They succeeded in 2023, growing 23.5% here. Evolution has about 70% market share in the live casino market. But in this picture, we can see Evolution losing market share in Q3. The growth of Sweet Bonanza seems to be the biggest reason, something to watch into the future. Note, these are the game shows only, not live blackjack, etc. This could very well be some short-term movement, but it is something to keep touch on if you are an Evo shareholder. In the picture above, you can see the top 10 game shows. 8 of them are from Evolution. This shows you their market position. They have the most enjoyed games. Like I said, that market share I shared earlier was not including live games like blackjack or roulette. But their lightning blackjack roulette games are also loved. This combines the original casino games with a chance to get 10 to 500x on your bets. Evolution leads this market, has the most fun games, and continues to innovate with new games. Just last year, they added 110 new games. As market leader, Evolution has huge scale to continue to make the most fun games. Because of this and their already existing games that are so liked, it's hard to catch up with Evolution. This also means gambling operations really can't switch away from Evolution. Less Evolution games available on your gambling website? Fine. Consumers will go to another platform. The switching costs for the consumer of a gambling platform are super low. You need Evo's games as a provider. I don't think this will change with their constant innovation. Evo's biggest cost item is personnel. This makes the business very scalable. If a live show remains the same regardless of whether 50 or 100 casinos use their service. Because Evolution was the first to succeed in this industry and can scale its operations efficiently, it has a big cost advantage over its competitors. But who is the competition? Playtech Pragmatic Play, Stake Logic, and Authentic Gaming? The competitors focus on the regulated markets. Pragmatic Play is the player with the sweet bonanza game that was taking market share, where I talked about earlier. They also have the number 9 game in the earlier shared top 10. This is the game that is taking market share. Playtech is a British publicly listed player. Just by quickly scanning their annual report, about 60% of their revenue actually comes from the consumer directly. They seem to focus on specific regulated countries for the B2B section. Watch the difference in EBIT margin here. Stake Logic is a player that focuses on the regular table games, but where you can talk with the dealer like you can see in the picture. They also have some very basic live casino games, which doesn't seem to be played a lot. And rightly so, because they're boring. But that's at least from the games I can personally see. I have been rather positive about the company and their market position. Then why is the stock down so much? 1. Higher cost and slower growth than first anticipated in USA, which is a growth market. 2. The company's margins have been lower this year. 3. The general growth of the company is lower this year than in the last few years, and this will continue in the coming years. Still, expected growth is around 14% in the next 2 years. Regulatory uncertainties. 5. A recent cyber attack in Asia. Their broadcast got stolen. They are working on a fix currently, but in their Q&A they said it will take multiple quarters, so no quick fix. And the last is the Georgia Strike 6. There was a strike in Georgia, Tbilisi, where Evo has the most employees. The reason was poor working conditions, low pay, and management issues. The Evo union demanded better conditions, and more worked joined the strike up to 2,000. This led to layoffs about 1,000. Despite negative media attention, there is no negative impact on regulatory relationships, said the CEO in the conference call. He also noted that Georgia is working on 60% of capacity, with an uncertainty if this will return to 100%. There has been shifted to other locations. Here you can see the employees in the last quarters, significant drop in the last quarter, partly due to the Georgia strike. On the long term, you want the employees to go up. Same counts for the number of tables. So there are a lot of issues currently. It's for you to decide whether you think these will be long-term or that it is short-term noise. Let's go to management. Jens von Baar co-founded Evolution. He used to lead the company till 2016. Currently, he is still the chairman of the company. Always a good sign that he is still involved with the business. He also still owns more than 10% of the company. Another good sign. The CEO is Martin Carlsund. He was Jens's successor. He used to be CEO of iGaming company Highlight Media Group. He owns 684,000 shares. Under Carlsund, the business has grown significantly, mostly by global expansion and smart acquisitions. Evo's CFO is Jacob Kaplan, who started in 2016 and has been CFO at another Swedish company before. He owns 60K shares. Todd Haushalter is Chief Product Officer in Games Operations. He owns 96K shares. Sebastian Johannesson is Chief Strategy Officer and holds 700K shares. They all have warrants, so they have to option to buy shares against a certain price in the future. Carlsund currently owns about 3 times his base salary. Not super high, about 0.34%, but with Jens von Baar still owning over 10%, there is skin in the game. I would love to end the management part with a quote from the CEO where he really shows his long-term vision. We will continue to innovate and break new ground, leading the way in providing the games of the future. We constantly have to move forward to be relevant 10 years from now and well into the future. At Evolution, we are never satisfied. We are always pushing to be better at what we do, raising the bar for ourselves and our colleagues. I want to thank my amazing Evolution team. Let's make Evolution a little better every day, together. Evolution's revenue has grown from $83 million in 2015 to $1.9 billion in 2023. This implies an over 40% compounded annual growth rate. The company has an operating margin of 63.5%. In the first 2 quarters of this year, that had dropped to 61%. In Q3, that number was over 65%. Because of these huge margins and the capital-light business model, their return on invested capital is great too, with a 10Y average of 55%. Last few years, the return on invested capital has been lower than that, but still well above my norm, with the lowest year being 18%, mostly due to higher capex and the acquisitions, and the goodwill that comes out of this, making their balance sheet bigger. So can't expect the return on invested capital to return to older levels anytime soon. The balance sheet looks really good with no long-term debt and $600 million in cash. This cash number was higher, but they have been buying back stock and acquisitions OFC. They also pay around 50% of profits as a dividend, which makes it a 3.25% yield at current pricing. I would prefer to see the dividend cut and all the money towards stock buybacks because of the low valuation. But in July this year, the company sent out a letter where they say they will continue to give out 50% of net profit as dividend, as they have since IPO. Risks, regulatory changes, competition, taking more market share. AI, this can be a risk as well as an opportunity. Could form a new way of gambling. Cybersecurity problems. Further negative impact of Georgia strike. Opportunities. New regulated markets. AI for a more personalized experience, plus better games. VR or AR gambling for a better experience. Continued online gambling adoption. More acquisitions to extend their portfolio. Upcoming growth markets. So let's dive into valuation. As you can see, the valuation is on an all-time low since the IPO in 2015. The forward free cash flow yield is 7.2%, and they do not have stock-based compensation. The company is expected to grow about 13% in the next 2 years. So yes, the growth will be lower than it has been, but does that justify the current valuation? I also did a quick reverse DCF with a 12% weighted average cost of capital, with 4% terminal growth, and the required growth would be at 7% currently. If we would use a 2% terminal growth rate, the growth would need to be 8 to 9% in the next 10 years. Sounds very reasonable in my opinion. I hope you have learned something today. Thank you for watching this video. I would appreciate a follow if you made it this far.